Good morning, everyone. Welcome to this update for global stocks and commodities for the 26th of February. Titled A Small Correction Due This Week. I'm not sure when it's going to happen, but I get the sense that it's probably going to be reasonably soon, as in the next couple of weeks. But equally, I don't expect it to be very much at all, because there's really no reason for there to be anything other than just a little bit of a technical pullback. So really nothing to be concerned about, even though from what I read, just about everyone around the world is worried about something. And it's either they're in the market and they're worried about a larger pullback, or they're not in the market and they're experiencing fear of missing out. Everyone seems to be worried about something, but the market continues to march on. And from a valuation point of view, there's no reason why it can't continue to trend higher. So let's take a look at the action last week. The S&P stacked on another 16 points. So it was another impressive week. And I really want to make the point emphatically that this is not rampant speculation. This is not high-risk traders just pushing the market higher and higher to ridiculous levels, even though that is a fairly strong theme in the media. This is an earnings-driven event. There's just no question about it. The earnings season that we've just had in America was a particularly good one. And as I see it, valuations at the moment are not a problem. Again, there are plenty of media players out there that are using statistics to make their point that the market is disastrously overvalued. But frankly, I just don't agree with that. Bull markets, and that's one point. That, in my perspective, the S&P at 17.5 times earnings, that's about right, given the earnings growth and given where the interest rate cycle is. So I'm pretty clear in my mind on that. The other thing that really encourages me about this situation is that bull markets tend to end on two things, and I've discussed this over and over again over the years. One, valuations reach an excessive level, and I don't believe that's the case. And also we reach a sentiment excess. So what that means is that most of the money is in the market. There's not much else to come in to hold the market up. You get a little bit of selling, starts the cascade, and down she goes. That's where major tops in markets are created by. And without those two things, it's almost impossible to get a major market top by definition. You just can't, because it just doesn't work that way. So that makes me feel reasonably comfortable about the long-term trend. Now, could we get sharp pullbacks? Yes. Do I think we'll get sharp pullbacks? Yes, I do. Donald Trump is so unpredictable. He's got this great knack of upsetting people. So I'm sure that we're going to get some sharp pullbacks. But that doesn't mean that the bull market we've had since 2009 is finishing just because we get a couple of sharp pullbacks. We had one, and we'll look at the chart in a minute, we had one at the start of 2016, and you may recall, if you've been watching these videos for a while, that I said at the time I was distinctly nervous about that, and that there was a possibility that we could be tipping into a bit of a bear market. But that quickly corrected itself. So those that took a little bit of precautionary action, that was the right thing to do. But then immediately the market reasserted itself. We got back on the bus again, and I just think that's the right way to play it. However, having said all that, expect a short-term pullback because the market has had one heck of a run. I wouldn't think that pullback would be any more than 3 to 5% at the maximum. So let's take a look at some charts. We'll start with the S&P, first of all, on a monthly chart. So this is very big picture view. Here is the lows after the GFC, March 2009. And you can see we've moved forward in a pretty easily definable wave structure, and we're now in the fifth wave. However, this fifth wave could continue on for another year or two. So just because we're in the fifth wave and we're getting towards the top of the channel and we're a bit overbought, doesn't mean that this has to end anytime soon. So, get that thought out of your mind. And that's what a lot of people are, the negative people are hanging their hat on, but it doesn't necessarily follow through. This is what is a bit more of an issue for me in the very short term, and that is just how far a market, whether it's an index or whether it's a stock price, how far it gets above the 50-day moving average, because that is generally unsustainable. And you can see that we're as far above the 50-day moving average as we normally ever get. I could pan back and show you all sorts of comparison periods, but I can tell you that this is about as far as she goes. And that's why I think a short-term pullback just to relieve a little bit of the excess is probably on the cards. You can see also that periodically the index pulls back to the red line, which is the 200-day moving average, and we haven't done that for some time. We had one in the middle of 2016, so that was associated with Brexit, and we had another one leading into the US election in November. So we might be sort of due in terms of time and excess on that basis. Let's take a look at the US dollar, because this is a bit of an important indicator for all asset classes. That's the US dollar, and you can see that we haven't really done anything much in the last week. It's really just gone up a bit, gone down a bit, and probably finished up around about where we started. If we then go to the Australian dollar, you can see we're holding this trading range. So the Australian dollar has now broken that downtrend. But what we don't know at this point in time is this a consolidation before a new trend to the upside starts, or is this just a pause period before the Australian dollar continues its downtrend? I really don't know. In the absence of stronger commodity prices, I would have banked on the Australian dollar being lower. And there's so many political things going on at the moment. Trump has said that he wants the US dollar lower. I don't know whether he can actually do anything much to influence that, to be honest. I think market forces are far, far larger. So I'm just neutral on currency. To be honest, I just ignore it. Now, the other one that I want to take a look at is the VIX index, because the VIX index remains at an exceedingly low level, and you can see it's been down here now for quite a lengthy period of time. The last spike we got in the VIX was in November. Again, just before the election. Ever since then, it's been all down. Markets have become very quiet and non-volatile. So you can see how often it is that we tend to get a spike. We're starting to get towards the end of the length of time that the VIX stays down. So again, I wouldn't be surprised to see a bit of a spike up into at least the mid-teens in the not too distant future on the VIX. While we're here, we'll just take a quick look at the Australian index. This is the ASX 200. We ended up down on the week, and since we broke out initially above this key $5,600 point level on the 22nd of December, we've run up to 58, come back to 5,600. Had a little bounce, back tested 5,600 again, another bounce to 58, and now pulling back. So the Australian market is really just stuck in this range between 5,600 and 5,800, and the Australian market I find reasonably uninteresting at the current point in time. So the Australian dollar steady at just under 77. And the Australian index down by 69 points on the week. And I must say the Australian reporting season was a little bit more disappointing than positive. And we've still got the same dynamic in Australia. If you miss expectations by even a small amount, then expect to get smashed in terms of the share price. It's unfortunate that that's the way that it is, but it's really down to computer algorithms driving a lot of the market, and if there's anything untoward, then the computers just kick in and they just sell violently. These are not necessarily decisions being made by human beings. Turning now to precious metals, gold surged higher by $22 on the week, but I've got a couple of buts and ends in here. What I find really unusual this is incredibly unusual, is that the GLD, so the ETF, the world's main gold ETF, gold tracking ETF, GLD, remains anchored. The gold holdings remain anchored at 841 tonnes. Now, we did dip down under 800, and then we've recovered, but now we've stalled again for several weeks. And so gold has surged higher on the week without buying into the ETFs. And also, future speculators are not playing the usual game here. The rallies normally get started by futures speculators. Step one is they cover their short positions, so they have to buy. So that creates some buying. Then the next step is other futures speculators come in and they buy to the long side, and so that adds to the build up on the futures to the long side. And then finally, once that has occurred, we then start to see money come into the ETFs. Well, the future speculators aren't doing that. They've not really decreased their shorts that much, and they certainly haven't increased their longs that much. GLD, money hasn't started flowing into GLD, and yet the gold price is rising. Now, the other possibility, of course, is that the US dollar fell, and that caused gold to rise. But no, that wasn't the case either. So the three key things that drive the gold price in the short term are not yet in play, and I've never seen that before. So it's a very interesting period. And the only conclusion that one can draw from that, and there is some evidence to this effect, is that there is some physical buying from Asia. So they're just buying gold physically in the market, not through the ETF market and not through the futures market. And that has pushed the gold price up. So there's a couple of ways you can look at that. You can say, well, that's dangerous, gold's going higher, but money is not flowing back in. Or you can look at it the other way and say, well, gee, the future speculators and the ETF players have really got some catching up to do. And I tend to lean to the latter. Maybe it's just my bias, but the way I'm seeing the market at the moment, I think we're likely to see a surge in the whole precious metals sector rather than a decline. The only note of caution I've got on this is that gold stocks are not yet leading, as we'll see in a minute. They're not falling, but they're not really rising. And again, that's most unusual. If you've been watching these videos for a while, you'll know that in the commodities market, the stocks tend to lead the underlying metals in both directions. So gold stocks are not zooming up in advance of the gold price surging. So it's a particularly unusual set of circumstances, and I'm not really going to hazard a guess as to how we should go about that. So let's take a look at the gold price, or we'll look at silver first. So you can see silver's had a really good run. We had a 2 or 3 day pullback here in January, but otherwise it's come off the lows just below $16, and it's just kept going up virtually every session, and now we're up close to $18.50. So that's been a big run in silver. This is gold on a daily. We had a really strong run up, pull back for 3 or 4 days, another strong run, bit of sideways, which is really encouraging. The fact that we don't get pullbacks after a rally. And now you can see Thursday and Friday, really quite a good surge. So we're back up now to the 200-day moving average. This is decision time now for the gold market. And if we just pan back a little bit more and look at the weekly, you can see that we've had a fairly strong run up there. So turning now to GDX. The GDX markets, this is what I'm saying with respect to the gold stocks. In fact, we actually saw GDX just down fractionally on Thursday and Friday when gold surged. So I'm not sure that that this rise in the gold price is going to be sustainable. If it is, then it flies in the face of the normal patterns in the market. So we'll just have to wait and see. So again, I'm, long term, medium to long term, I'm bullish on gold. In the short term, I'm neutral and I don't really have much of an opinion, and I think that's the best way to play it, and you should position yourself accordingly. Have some gold, but certainly don't overdo it, trying to second guess the fact that we might be at the start of a major rally, which I also think is possible. Copper had a bit of a sharp dip and then recovered to $2.68. And base metal stocks just basically fluctuating up and down. Crude oil moved ahead to $54, but it's still within its trading range. So still within this 52 to 55 range. Earnings for the sector are starting to lift, obviously from a negative. But it's going to be the service companies that are going to be the winners regardless. The drilling industry in America is really picking up. Trump is pushing that to raise America's oil independence. So it's the drillers, it's the service companies that are going to do well, irrespective of what the oil price does in the short term. The bigger winners will be the production companies. So if and when oil does break out, you will make more money from production companies than you will from service companies. But the service companies are going to do reasonably well anyway, because they're going to see their demand go up, and their profits are going to move ahead. So in the crude oil sector in particular, buying the dips is essential. You certainly don't want to chase anything, because I'm not convinced that oil's ready to break out yet. There's the spot copper chart. Not a lot of movement on the week. And now just to wrap it up, there's a huge amount of noise out there. As I said at the start, so many people are nervous or negative to do with something about the market. It doesn't matter what it is. Everyone's unhappy about something. So I'd really encourage you to ignore all the noise that's out there about how and why the market should be topping out. Use sector rotation to advantage, and I talk about this most weeks. Apply some diversification, but not for diversification's sake. Make sure that you're in sectors that have got the overwhelming probability of moving higher, and make sure that you focus on the sectors that are already strong or that are emerging strong sectors that have come out of bear markets. And I've referred to them in recent weeks, being copper, uranium, agriculture, precious metals, and even healthcare is coming out of about an 18-month bear market. So focus on the emerging sectors, focus on the existing strong sectors, and get some diversification. And rather than choose a sector like get really bullish on precious metals and then throw all your money in precious metals, that's not the way to do it. And do not succumb to the fear of missing out. It's late stages, even in short-term rallies, when people start to really get agitated that they're not in the rally, and so they experience this fear of missing out. You've got to have a game plan. You've got to stick to the game plan. You want to buy the dips, and you just want to play the market sensibly and use the rotations to advantage. I get emails from various people saying, look, the market's going up. What should I do? You've just, the first and foremost thing you got to do is stick to your game plan. It's critical. So don't throw caution to the wind. This is not a time to chase the market. I'll just recap the final slide that I had last week. I think given where the market is at, it would be prudent to, with prices reasonably well extended above their mean, then you want to look for a couple of things. You want to look for intraday reversals, and if you see those in individual stocks or in sectors, that would be a time to lighten off. Take some partial profit. If you're into the options market, write covered calls. That's a great thing to do because it gives you added premium. And this partial cashing up helps you to capitalize on the next dip, which is what this is all about. It's a chess game. You've got to be playing 2 moves ahead. You don't want to wait until the correction starts and have no capital, because then you've got nothing you can work with. You've got to be cashed up in advance of the next dip in the market. So that approach will help you capitalize on the market. I did mention last week that there's some things I'm doing in America which are generating very regular income through the use of the options market of the order of at least 5% a month. I must admit, I was a little bit surprised at I only got a few people who queried what that meant. So I'll just mention it again. If anyone is interested in being able to generate that sort of level of consistent income, get in touch with me and we can have a chat about it. So that's it for this week. There's my contact details, and I'll be back with you next Sunday. Cheers.